My background is very much as an operator. I've been in the startup ecosystem for 9 years, 6 of which has been spent in food. Previous to that, I had been able to join as an early employee at a financial technology startup and be a part of this sort of rocket ship ride of a company at the center of what was at the time called the fintech boom. So quite a different space, but similar in being nascent, and I'd say sort of at an inflection point as an industry. And while I was there, I learned so much in helping the company grow and scale. And eventually, as we got bigger and had more of a team, I really built out a specialty in marketing and brand, learning from like an incredible multi-exit founding team, ex-Google, ex-Facebook folks. And when that company was acquired later on, I was serendipitously introduced to my now partner, Ellie. I think I had been eager to take everything I had learned there and what I clearly loved so much about the startup journey, the founder journey, but get into food and more specifically natural and organic, which I had just always been passionate about and drawn to, both I'd say personally, having grown up with sort of this food as medicine ethos. My mom is a chef and was really just ahead of her time on that front. And, you know, just seeing that proliferate into the mainstream, largely driven by the work that Whole Foods was doing, was just something I really wanted to be a part of. So I jumped into the food world and had the chance, meeting Ellie, to work really across the value chain from the co-packing and manufacturing layer. We ran a 50,000 square foot facility in central Pennsylvania that was co-packing and sort of aimed at being a better partner for these sort of emerging better for you brands, to building and launching brands into the market, and then on to investing, first with another New York-based fund called Almanac, and then with Newfair, our own fund. And so that sort of operator background that me and my partner bring, Ellie was coming off of nearly a decade at Whole Foods when we met. That was really a key impetus for creating Newfair. You know, our experience both upstream and downstream in food as, you know, founding teams, and she and I having held titles of CEO or CMO respectively, really recognizing that kind of strategic capital is so crucial for young brands. I'd say especially in the food industry, which I think more than most other industries or categories can just be specific in how much like resilience and grit it really takes to grow and succeed. So along with that value add to our portfolio, we also recognized our unique kind of combination and background and experience offered an advantage in terms of how we look at and assess opportunities. It helps us to sort of see through the fleeting, buzzy trends to understand, okay, what are the real movements? What are the real consumer behaviors behind these that we actually want to bet on? So for us, identifying those and like building the thesis of Newfair always starts with the consumer. When we talk about Newfair, we often say we're looking for brands that serve the modern eater, which is to us just represents a group that is really driving the future of food. This means, you know, a new consumer, younger millennials and Gen Z that are aging into their spending power and represent these massive demographic and behavioral shifts. They're purchasing against their personal values, you know, climate consciousness, social impact, health and wellness. They're more educated about food than ever. And while these behavioral shifts create a lot of opportunity, they also mean that there's just a higher bar to meet that consumer need, to delight that consumer. So we really take a consumer-centric approach. And I'd say in today's environment more than ever, it's for us, it's about finding companies that offer a product or a service that a consumer just can't live without in their daily life. So, you know, when we talk to founders or early stage leadership teams, we're always coming back to the fact that like the question or the point that's driving everything for you from the very beginning should be, what problem are you solving in the life of a consumer? Is that really a problem? And is it a problem for a significant large group of people? So today we're going to talk, you know, a bit more about that, and we're definitely going to talk about the current fundraising environment, the criteria that you can expect venture funds like us to be thinking about, requesting from you, scrutinizing if they're considering an investment in your early stage consumer company. And, you know, I mentioned early on, we're a specialist fund. We focus exclusively on food. So while these metrics that we're going to talk about maybe can apply broadly to consumer, I'd say we'll really take the lens of a food CPG startup. What is best in class? What is expected for those? So if we want to move on to the next slide, just to ground ourselves a little bit in what I mean when I say today's environment, which maybe some of you have already experienced if you're in the fundraising process or you're about to embark on it, you might be hearing some less than encouraging, less than favorable things from other founders who are out there in fundraising. And I think generally there's been a lot of mixed messaging, but from what we've seen, from a broad overview of what we've seen, it's a pretty interesting time. Adrian and I were just talking before we got started. It's been an unusual, unprecedented year, I'd say, that has come after over a decade of what we really observed of hyper growth in this space. And from about 18 to 24 months ago, you sort of started to see macroeconomic forces converge that created a very different environment. You saw increased inflation rates, increased interest rates, COVID fallout, not to mention global unrest. And it all led to this general cooling from investors in the consumer space, certainly in the consumer food space, who previously had flooded the industry and enabled, these massive valuations that were kind of underpinned by unsustainable, unrealistic growth expectations of companies that they did not meet. And so today, a lot of that capital has receded. We saw private equity pull back. We're seeing pressure on retailers, distributors, them really, I'd say, no longer supporting inflated valuations. They've come down, multiples have come down. And when we or any other venture fund digs into a pipeline company today, the fundamentals just matter that much more than ever. Whereas up until I feel like 12, 18 months ago, the kind of intangibles like the promise of a buzzy brand or a celebrity attachment or fitting squarely within a burgeoning trend like nootropics or non-alcoholic beverage might have been enough to attract funding for your company or even inflate or even underwrite a sort of inflated valuation. Today, the market is much, much tighter and it's much more scrutinizing, where some of those glossy attributes I mentioned, they just can't compensate and don't compensate for showing strength in the core competencies of a business. So we'll talk a little bit about those core competencies on the next slide. For New Fair, we can really group it into a couple buckets, and you've probably seen, and are very intimately familiar with all these metrics for your company and for your business. It's something leadership teams and founders work with daily, but I think it's important always to remember how they come together and tell a story about these fundamental buckets. So for us, we're always looking at proven market fit. So going back to that consumer demand and consumer-centric approach that I mentioned before, what are you showing us today that proves that customers, a broad group of customers, can't live without your product and are going to go back to it again and again? Operational efficiency. So really understanding, okay, if you created a product that people want, are you able to produce it, distribute it, market it, sell it in an efficient way that uses capital efficiently and makes your company competitive to others? We look at attractive growth and capital efficiency. So if you're doing this today, do you have the potential to grow in a sustainable way and get big and maintain those attractive unit economics and gross margins? And then lastly, just, this overall discipline and ability to execute that throughout the entire, I'd say, diligence process or the time when we're getting to know founding teams, we're really trying to gauge and assess, like, is this a team that can actually deliver and execute on the plan that they've set forward? And things like burn rate and historical financials, of course, are like hard facts that speak to this, but also more qualitative things like how often are your team members leaving? Are you able to attract and hold really great talent? Do you have competitive and interesting, unique relationships with retailers, things like that? I'd say the ranges and best-in-class numbers across a lot of these metrics will differ across categories and size and stage, and investors definitely recognize that it will take time to get to the right levels. If you're just starting out as a new company, it's not expected that you're going to have best-in-class numbers across every single one of these. But at the same time, if you're not even close to where we'd expect a company of your size and stage to be, that's going to be a red flag, and it's going to create a lot more risk for an investor, especially during this time when business deals are inherently more risky. So we think a lot when we talk to young companies and encourage them in early strategy is, how can you be showing your proof points and what you've accomplished, even at a small scale? with these and still even some of those more ephemeral items, something like outstanding community engagement or content virality, off the charts retention. I think it's just to keep and take with you that general understanding that the bar for investors today to build conviction is just that much higher. And maybe grabbing a couple of these and just like digging into what we actually look at or think about when we see them, looking at velocities within that first bucket, measuring how many units you're selling per store per week. This metric can be really powerful in illustrating that you've created something people want, that's high quality, that's priced well. And if you can show that you're outpacing the category and your competitors in terms of how frequently you're turning on shelf, again, even if only within a small footprint, that's really meaningful. I think it's important to remember that to do that at retail often requires sales and marketing support. You're spending a portion of your revenue, of your gross sales, on discounts and promos. You're using resources to make sure your products are well merchandised. It takes time and money to show those strong velocities. And so, we often, or sometimes in early conversations with companies, we'll hear brands that are very young planning these massive distribution rollouts quite early on, in year 1 or year 2, saying that they're going to be across various retail channels, conventional, natural, club, because, they've gotten a call from Walmart or Target and they want to capitalize quickly on those opportunities. And from our perspective, that often makes us more concerned and nervous than anything, because we know how hard it is, or often unrealistic it is, just to support all those launches all at once, to see the strong velocities that you want to get to as an unknown brand, that we're looking for as investors, but also these retailers are looking for to actually keep you on shelf. So as I mentioned, rather, like, we love to see a brand being thoughtful about their distribution build, starting maybe in their home city and the surrounding geographies, and really building a product fit story that is strong, and then showing us how it can be replicated in different places. Looking, for instance, at gross margin here, this is a big one that I'm sure every investor, if you're out there fundraising, is asking you for, but is huge in terms of maybe saying the most about if your company has the potential to operate efficiently and grow sustainably towards profitability in the long run. An investor will always want to make sure these are measured and calculated properly. So that for us and broadly means taking your gross sales and deducting inventory adjustment, which is often the same as spoils, trade spend, COGS, and freight in, and taking that as a ratio to your gross sales. As I mentioned before, investors definitely understand that you're not going to be at the perfect target number at the outset, that you'll have work to do, but there does need to be proof to being on a path to attractive margins. If your gross margins as a food CPG company are below 30%, that can be a red flag. That can be a tough sell to venture investors. We want to see you approaching 50s and higher in the long run in terms of gross margin percent. So when we often expect early companies to be at least mid 30s and then have a clear actionable plan for improvement. Exactly what's happening with your COGS, with your co-packer, with your volume changes that are going to get you to grow that gross margin and get points back there. And then, maybe looking, for instance, at some of these e-commerce metrics, in the third bucket, that lifetime value, for instance, to CAC ratio. So I'd say with all of these, if e-com is a part of your revenue mix going forward, investors need to see that you can grow efficiently and attractively there. So if you're thinking about CAC, customer acquisition cost, as your total paid marketing spend divided by the number of customers you've acquired, and lifetime value as how much your customer spends with you over time, you really want to see how much a customer spends versus how much you paid to bring them in. So we look for, best in class ratios of 3x or higher are very strong, but we definitely want to see companies approaching that. And if, we send a question out to a pipeline company saying, what's your LTV to CAC ratio? And it's 1 or below, again, that becomes a big red flag. And then, I guess, maybe we'll wind up coming back to this side and some of the questions if it makes sense, but just moving on to the next one for now, I guess I'd say, I've talked about now a couple of times, and you've heard me say this idea of building conviction and venture investments, building building conviction in an investment, in an idea. But I guess maybe to just ground ourselves in what that actually means for venture investments. We're looking at the metrics and the buckets in the previous slide to try and understand at this early stage, which is difficult because of course the future is completely unpredictable and anything can happen, but can we build a thesis around, can we truly believe that this company can grow to a meaningful size over time, 60 million, 70 million, $100 million in sales, and that when they get to that point, will they be operationally efficient with unit economics and metrics that are attractive for exit to either the public markets if they're going the IPO route, or to a large strategic if they're looking to be acquired. And I guess really just on the next slide, it's to remind that that's not because that's the only mark of success for a young food CPG company, that's the only way you can build something worthwhile, but that is rather because as venture investors, those large exits, those meaningful events, that is the only way to make our business model work. We need to create value and a return for our investors, and that comes from these exits within our own portfolio. So we need to believe and build conviction in that outcome if we're going to invest in a company. But again, I think that's to say that it doesn't mean that, showing that you're going to grow to 100 million in sales and get acquired is the only way forward. As founders or as a leadership team, there are many ways to build a successful, long-lasting, generational business that is profitable and creates value for its stakeholders. That can often be smaller. That profile just might not be right for a venture investment, but it may be the best path. If you've got a product that is truly specialty or very artisanal or more niche, or if for so many reasons, from total addressable market to just lifestyle choices, you prefer a slower, steady growth, or that's really what's attainable for the product that you're selling, that can absolutely create an extremely valuable company and experience. It might just not be, something that a venture investment could get comfortable with. A venture investor could get comfortable with. So I always think it's important to go back to that this is not, the only path forward. And yeah, that's really mainly what I wanted to sort of chat through or kind of give background on first. And then I thought if we want to get into some questions, that would be great.
Thanks, Hallie. Okay, so we're starting the Q&A. Who would like to go first? You're welcome to drop your questions in the chat or DM me directly. You're also welcome to raise your hand and unmute yourselves and ask directly. Don't be shy. We're all here to learn.
I have a question.
Go ahead.
Well, hi, Adrienne. Thank you for organizing this. And my question is really about some challenges. So for example, for us, we were in the, bootstrapping in the $500,000 range year over year. And then because of lack of capital, we lost one of our retail account, and that caused our revenue this year to be half of that. So my challenge going back to investor is, how do I pitch our story? Because I'm getting more retailers wanting us to come as early as April of next year, but I'm also afraid of the lack of capital and not being able to provide that level of inventory and keep on running into the same issue. How do I convince people that we have, great opportunities in our pipeline? The decline this year was because of, again, lack of capital. We couldn't meet the demand that we had. So I'm trying to figure out a way to phrase that story so it makes sense to investors, and it tells a better picture than what's currently happening.
Yeah, well, thank you for the question. I mean, I guess I'd say, well, firstly, that's definitely not uncommon in terms of capital or the access to capital to kind of restrain how you're able to grow distribution. And I think it's become a bit of a chicken and an egg situation, especially right now in this tighter environment where you'll have venture investors saying, oh, we want to see more proof points of how you perform in conventional retail before we get comfortable investing. And you'll sort of say, okay, well, I have those accounts ready to go, but I can't actually launch them until I've got funding. So it's definitely a bit of a tough situation. In terms of positioning, I think, completely fair to just speak to your company and the responsible growth that you've been pursuing, that maybe you instead of deciding to pursue growth at all costs and bring on capital from folks that maybe wouldn't have been the right partners or just any source that you could find. You wanted to instead grow steadily and responsibly. So you just decided to forego those, retail opportunities, or to hold off on those retail opportunities until the right capital was there, until you knew you were really resourced to handle them well. Because like I mentioned before, again, just getting into the retailer is only half the battle. Once you're in there, you have to prove that you can stay. And often that takes money as well. So I think that's very much the story of, your timing and your build. You wanted to match your access to capital. And I think the right investor, if you're showing that you're doing $500,000 a year from the start and you've been growing since then, the right investor will definitely understand that and understand the year that it's been,
Okay, thanks so much, Haley.
Okay, the chat is looking healthy. So the next question is, what is a healthy growth percentage year over year in this climate?
Yeah, I'd say in this climate, like, investors are definitely looking to see more realistic growth percentages, but at the same time, that doesn't mean, pursuing profitability over growth. It's important to remember that, again, as venture investors, we still need to see that there's a major growth opportunity. So I'd say, I certainly wouldn't be projecting anything over 100% growth. Doubling from the year before is definitely going to maybe feel a bit unrealistic. But I think within that, it really should just be based on exactly the strategy that you've set out and the resources that you have. So when a company has maybe more resources on the financial side, or maybe this is something that you could do now, you really can get as granular as to like project a door by door build. So say, okay, this is the team that we have. These are the commitments we have. This is the capital that we have. We expect that we're going to launch in this many doors this year. And we know our velocities are this, so that equates to this much, revenue growth. And I think as long as you can back up the projections that you're showing, there is flexibility. We just want to see that there's a concerted and realistic plan that your projections are grounded in.
Okay, great. The next question is, within frozen meals entree category, what is the fully loaded gross margin that you prefer to see for your target investment?
Yeah, like I mentioned, it does differ a little bit from category to category, but I would always be, as like your North Star, looking and thinking about those high 50s, even into 60 gross margins, like in the long run of that being what people are targeting. And then it's really just a matter of, okay, how far off are you from that today? And what are you doing to work towards that? Obviously, frozen is tougher and involves a different supply chain. But one kind of easy rule of thumb, I'd say, to understand just like exactly what your target gross margins would be is look at the public filings and the public financials of some of these larger strategics. So understand, okay, what is their frozen portfolio? What are the gross margins on those? And to think about, when I am large, when I am bigger, if I'm going to be an interesting acquisition target for them, my margins are going to need to be accretive to theirs. They're going to want to acquire me if I'm bringing on better margins than they already have in their frozen portfolio. So I think that kind of can help to guide in terms of figuring out exactly what your target should be. And then it's really just working towards there and trying to build towards that.
We have a question from Cameron. Do you have a scorecard to benchmark performance across different metrics? For example, more examples like you provided with the margins, less than 30% is bad, 30 to 50 is good, over 50 is great. Little loaded. So the question again is, do you have a scorecard to benchmark performance across different metrics?
Yeah, not so much a hard and fast scorecard where we're saying like, oh, they got a 10 on gross margins, but they got a 0 on retention or something like that. At this early stage where companies are young and there's so much influx, it really truly is like a combination of everything on the slide that I mentioned before, and then many other like qualitative items that you're looking at. And it could be something there could be sort of nuances within the history of a company. Maybe their gross margins are lower than you want to see today, but they know, or that they just moved co-packers and they secured a great exclusive co-packer relationship, and they're showing us that they have firm projections of 40% margins going forward. Things like that will all move the needle. So it's not quite as black and white as a scorecard, unfortunately.
There's a couple of other questions regarding benchmarks, so I'm going to go to those first. And I'm sorry if they're one and the same, but do you have a benchmark for a time to profitability from a CPG startup?
Yeah, again, I wouldn't say a hard and fast like horizon where we want to see profitability. I would say that, again, in this time where there's been such a constriction of capital, you have started to hear funds and founders talk more about prioritizing profitability and getting to profitability quicker. And I think what I'd say is it's important to show maybe that there is a path where you could get to profitability quicker, maybe in 5 years. But I think also you don't want to forget that, like I mentioned on the previous slide, there's no real exit potential or massive outcome potential for a company that's profitable but only doing 10 million in sales. So at the same time, you do really want to be able to show that this can get really big, that you have levers to pull to say, okay, if capital is tight and this environment continues and we need to work towards profitability, we can get there. But if things open up and we want to be back on that journey where there's like true exit potential, this is a large addressable market. This can get very big. This can scale efficiently. And yeah, I'd say, food companies are usually like a longer build or a slower build. So I'd say anywhere from getting to profitability within that, 5 to 10 year horizon is typically what we are looking at.
What is the average holding period for portfolio companies, and when do the funds have an expiration date?
An expiration date or like it's a horizon for a fund will really differ. Typically in consumer food, we see a slightly longer horizon just because of the understanding of the kind of length to outcome. So for us, for instance, our horizon is 10 years. So we're looking at holding companies and expecting exits, outcomes, opportunities to get value back from our investment, ideally, around that 7-year mark.
Is there a minimum revenue that an investor would be looking at in order to invest? And if so, what would that be?
All completely based on the strategy of a fund. So there are funds that invest, pre-seed and seed, which can often mean pre-launch. So you're pre-revenue, you haven't launched something into market. That is a little earlier than we invest. As Newfair, we invest in seed and Series A rounds, and we're usually looking for $1 million to 2 million in ARR, so in annualized revenue. But again, there are earlier funds, and then of course there are much later funds where you'd want to be showing much larger revenue.
What revenue multiples are you seeing on valuations?
Yeah, I think important to note that the sort of environment of the hyper growth or the past 10 to 12 years that I was mentioning was just, it was often multiples based on forward-looking projections. That you could say, okay, we're projecting we're going to do $20 million next year, even though last year we only did 10. And you could get a valuation based on that. But yeah, as I mentioned, we've seen that come down to earth a lot. We're really looking at valuations based on the previous year's net revenue, and anywhere from like 3 to 4 times.
What are the typical value adds that Newfair can bring to a CPG startup or emerging brand?
Oh, sure. Well, love this question. I guess we definitely think and hope that that's like a key reason that our portfolio and other brands might want to work with us, just because, as I mentioned, we really do have that operator background. So I sort of got at this when introducing Newfair, but Ellie, my partner, spent 10 years as the global director of local brands and product innovation at Whole Foods, which essentially she just meant she was the person, picking and choosing and going out and sourcing the brands that would launch at Whole Foods. She did that for a number of the kind of most iconic examples of that time of Sir Kensington's and Who Kitchen and RX Bar and thousands of other brands that stayed small. And along with that, she was really on those growth journeys with those brands, figuring out their challenges in distribution and manufacturing and helping them to grow and scale. And then from there, as I mentioned, that co-packing manufacturing layer of experience that we bring is unusual, I'd say, maybe from investors, just that deep understanding of what actually goes into commercializing your product and making it at scale, and producing it. And then, as I also said, we had the chance to kind of build brands along the way. So one company that's in our portfolio today is the company that Ellie is the co-founder of, and I built alongside her and the chef, the celebrity chef, Bobby Flay. It's a brand in pet food called Made by Nacho, and we really built that from the ground up. You know, I was head of marketing until we placed the whole team, and so everything from product to team to operations to marketing to sales, all under our purview. And I think that's really just what gives us the added edge in terms of the value add that we bring to our portfolio, is that we've either done it before because we've really been oftentimes in or close to the founder's shoes, so we have a lot of heart for the journey. And if we haven't done it before, we know the right people to call to sort of find you the answer that you're looking for. And a lot of that comes from network, I would say, and that's applicable both to, you know, the commercial side of it in terms of retail and distribution or manufacturing and things you might need, but also team winds up being a pretty big factor. Obviously, you know, your company is only as strong as the talent that you attract, and then us being able to make those introductions or place ends up being pretty valuable.
I'm sorry, Hallie, you actually cut off that last line. Do you mind repeating that? There was a little delay.
Not at all, no. And just shout if you can't hear me at any point. I think I was just mentioning network and that being a pretty big value add or advantage, which obviously has a big impact in terms of, you know, your commercial and your business development side of retailers and distributors and manufacturing your product and how everything comes to market. But I would also just mention, especially on team. So, you know, I think I said that that a company is really only as strong as the talent that it can attract. And that's been a key kind of area of value add for us to date, is being able to introduce and connect and place kind of key leadership or key talent at a given company.
Should a startup CPG hire a broker in the beginning? Also, what is the best way to convince a supermarket to have your products in eye-catching areas?
Yeah, good question. I don't know if there's a sort of standardized answer for whether you should hire a broker in the beginning. I certainly think in lieu of, if you know, having a specific role on your team that's owning sales, who already has those relationships, a broker can be really valuable. But at the same time, ideally, you do want to have some of your own relationships with retailers and be starting to kind of build those as well. But we do typically see brokers be a part of the kind of the puzzle of resources early on. And in terms of what you can do to get a retailer to buy your product, so I mean, first and foremost, have a product that people really need and really want, going back to that customer. You know, being able to show that this is a product that isn't out there today, that doesn't exist in spades, which is not easy to do because a lot of categories in food are very, very saturated. Having clear differentiators, you know, being on par price-wise, just from a product perspective, being really solid. And then after that, I'd say a lot of those kind of ephemeral items I mentioned before definitely matter to retailers. So like if you have a super buzzy brand, if you have a lot of content virality, if you have people really talking about you and asking for your brand, that often leads to a retailer coming to you. You know, that's a key reason people invest in marketing and brand. And secondly, I'd say, you know, looking at categories too, like understanding what is a retailer focused on right now. You know, we look at Walmart a lot recently, who's clearly kind of making a push towards Gen Z or even Gen Alpha and trying to be like a real go-to place for them. So, you know, how can you align with the initiatives of a retailer and what they actually need for their business?
What is your advice for a company that is sustainably profitable with revenue less than $1 million, but needs capital to scale to reach $1 million?
Yeah, good question. I maybe would caveat that this is a little like outside of my venture world. So just thinking about it like that, I would say, yeah, if you're already at profitability and you're hitting that revenue close to $1 million, but you're not necessarily showing a strategy that says, okay, and now is our massive inflection point, we're going to raise X amount and we're going to grow 10x over the next 3 years, which again will be seen as difficult right now. I think I would start to look at and understand other creative or fundraising sources. So there's a lot of opportunity and potential in the debt world. I think it's important always to not forget angel investors. Angel investors will have a lot less not sophistication, but a lot less sort of hard and fast metrics that you need to hit in order for them to get comfortable. Often angel investors invest in a company just because they are very much aligned with the team and the product, and they see the potential. They don't necessarily have as many stakeholders to answer to, friends and family. And depending on the type of product that you have, grants can be interesting. But yeah, I'd focus on those couple different types of funding that could get you to that next level, and then potentially be on a venture path from there if that's, again, aligned with what you're actually looking for.
I'll let you take a quick break because I feel like this has been a speed round of questions, but truly appreciate all the insight. And from everyone attending, again, feel free to drop your questions in the chat or DM me directly. You're also welcome to unmute yourselves and raise your hand if you'd like to ask a question. Okay, so the next question that we have is related to your investment in Vista Hermosa. Can you kindly share what you've learned over the last year as macro sentiment has softened about consumer willingness to pay for premium frozen brands? Are consumers comfortable with paying for a full meal, or are they showing preference for smaller sized frozen meals?
Yeah, good question. And yeah, Vista Hermosa is the CPG line of Tacombi, which is Mexican restaurants across New York and now across the entire country. And they offer really high quality, authentic Mexican products. So there's Totopos, there's a Totopos line, which are tortilla chips made of 100% nixtamalized corn that they make. And there is 2 tortillas. There's a corn tortilla and a flour tortilla that are just excellent. Those are sold like slacked out near the avocados in grocery stores. And then there is a line of frozen burritos so that they offer. And I guess from that perspective, or thinking about their frozen opportunities specifically, we've been excited about frozen. We think it matches a behavioral shift that it sounds like you're mentioning of consumers working from home more, this more on the go, quick, easy, convenient format of eating. But again, it has to be able to play within the newer macro environment and folks being more focused on value than maybe they were before. I'd say for Vista Hermosa specifically, their frozen burritos are $6.99 at shelf. They're pretty large. They offer a really hefty meal for one person, or even something that could be shared. And I would say those we've seen just like fly off the shelf. There's a real appetite for those. Their main problem would probably be out of stocks on the frozen burrito line. But I would say looking at other brands that are maybe more higher priced or in higher tiers, I would say now is the moment to be very careful with pricing. Like, you really wouldn't want to be launching a frozen product that's out of whack with what's out there already. If anything, you want to be on par with your competitors, or if you can be slightly lower, ideally, that's great. But I wouldn't think that right now there's massive appetite for like the most premium frozen meal. You want to be offering that convenience and fitting with this new lifestyle, fitting with this new behavior, but right now not asking for like an added strain on the wallet of your customer.
Great. Suala, you are welcome to ask your question.
Thank you. Hi, Haley. Thanks so much for your time and generously answering these questions. I have a couple questions. One, recently the whole plant-based ecosystem has taken somewhat of a hit and negative press, whether it's plant-based meat, in particular, due to, some declining valuations in that category and things like that. So one, what's your take on that? Do you see that as a space that is not growing or that has the potential to grow? And number two, so my startup is an early stage. We're pre-launch, pre-rev, a plant-based milk company using a novel raw material like a millet, and we create milk with 8 grams of protein and same calcium as dairy with a clean label. But when I talk to investors, there is a very quick sense that they just see the category as an overcrowded, competitive. There is no space for new alternatives. There is already enough. I don't think this is going to work type of mindset. Although we've done a lot of consumer shows, we've actually sold products to demonstrate that people are willing to pay that price, and shown the, I guess, consumer validation as much as we can at the stage we're at. And we have distribution and retailers interested, distribution set up. So there is interest there, but there is a sense of fatigue among investors. So I guess what we have I believe we have a clearly defined unique value prop, but any suggestions on how to convey that in a better way while speaking to investors or while raising funds? Any thoughts and would be appreciated.
Sure. Well, thank you for the question. And yeah, maybe just to address what you mentioned first, like broadly on the plant-based side, I think, again, with our customer-centric approach, Newfair has not necessarily ever been excited about the sort of lab-grown meats or the protein isolates or the meat alternatives that, as you're mentioning, have taken a bit of a hit in terms of valuation, consumer perception, growth, all of that. I think mainly driven from the perspective of health and wellness and taste, and feeling like the health profile, the nutritional profile, and in many cases, the taste profile really hasn't gotten there. I think like there's amazing work being done right now, and we see like incredible technological advances, but yet to be seen if those can be brought down to price parity and produced at scale. So it's definitely a space that we watch very closely, but aren't necessarily surprised to have seen like a bit of that pendulum swing or that backlash as consumers maybe realized that they weren't getting that intrinsic value from some of the true meat alternatives that were out there. I would say on the other hand of that, we do love plant-based, and you'll see in our portfolio, one of our investments is Actual Veggies, which is a veggie burger that I would call true to the name, a true veggie burger. It's not using any isolates or lab-grown meat. It's truly a number of different vegetables that you're getting all in one. It's delicious, and they do very well. And that's the kind of thing that we think has a real consumer, has someone already primed to be purchasing that, and actually has a really unique position on the shelf in the frozen aisle, and they do very, very well. And so in talking a little bit about your company, I think, yeah, it is, a tough time. Investors have seen that plant-based backlash and maybe interpreted as just being like, oh, generally plant-based is cooling or something like that. And then on top of that, you have got the milk alternative space, which, more and more competitors are in. I think what's important to maybe show or remember that you were getting at earlier is, okay, your unique attribute, which sounds like it's the novel input of millet and how you're doing that and how you're processing that. I think important in the small ways that you can, understanding that's being scrappy and bootstrapping right now, like showing that specific millet attribute really does move the needle, and that you have proof points within consumer groups or within wherever you're selling today to show that, yes, there are many plant-based or dairy alternatives out there today, but there's no one doing millet like this with, no gums or oils or whatever other attributes that you have. And there really is space for this in the market. Again, that like chicken and egg situation that you run up against of investors being like, we need to see that, and you saying, oh, but we need capital to be able to get there. It might just be a matter of finding that earlier, right, investor right now who could support you in getting some of those proof points, whether it's like an angel investor, a family office, some of that more friendly capital who could get behind the millet story, the ingredient story here, and allow you, that leeway capital wise to show some of those proof points. I think to then get in front of a venture investor and say, okay, look what we've done with this small amount of money. We've proven that millet is really interesting. We're the only ones doing it. We're going after it.
We have a few more questions, but I want to give a quick plug in case, somebody has to leave the call a little bit early, but a week from today, we are hosting our Jingle and Mingle holiday mixer at Bolton and Walk downtown. I guarantee this event will sell out, but please come and not just celebrate the holidays, but obviously grow your network and connect with all our incredible sponsors that are actually going to be there. And it's going to be a good one. I got some fun surprises up my sleeve, of course. So I dropped the link there in the chat. Hope to see you there. Okay, yes, Actual Veggies is phenomenal. Haley is on our board and has been a great contributor to the organization from the beginning. I am also a huge fan. Okay, so next question, we have Lex Evan.
Sorry, I was on mute. Hi, two-parter. So going back to the valuation question, aside from revenue, what other factors would you consider as important in determining your valuation cap? And the second part is, would a letter of intent suffice for that 1 million ARR hurdle to begin conversations?
Yeah, so like a letter of intent from maybe like a retailer showing that you have a contribution.
A major airline partner. Sorry.
I cut you. Say that again.
It would be a major airline partner. So it's also a different channel, which could be a third part question.
Okay. Yes. I think, well, on that front, to answer that first, I would like the letter of intent and basically just showing how far along you are with a future commitment is definitely important. Like you can say that that's locked in for 2024. That's important. When we ourselves look at ARR, we are looking at like the historical month. So maybe the past quarter times 4 or the past couple of months, whatever that is, we want to see like past revenue annualized. So, and also again, that's sort of maybe a sign of the times, but that you're not necessarily getting credit for what's to come. You're getting credit for what you've already done. And then, yeah, in terms of other metrics that support valuation, and we'll share this slide afterwards, but I would really go back to that slide of the kind of the core fundamentals of, certainly what gross revenue you're at, but your unit economics, your gross margin, do you have amazing retention on D2C? Do you have like this, do you have crazy velocities that no one's ever seen before in the category? All those types of things will impact it, to a point. But I will say right now, there isn't as much room to be like, oh, they did this amount of revenue, we would give them a 3x valuation. But because, they have such great velocities, we're giving them a 5x. Like those deals, from what I've seen, aren't really happening right now. It is sort of that more sobering approach.
Thank you.
Thank you, Lex. We also just brought up the core metrics slide again that Hallie was just mentioning. Okay, so our next question here is, what is the best way to reach out to investors? Do you accept cold outreach?
Yeah, I think, funds will always have the contact button or a distribution email that you can be reaching out to, and absolutely accept cold outreach. Like we monitor that email thread of ours constantly. I think, you'll see a lot of funds, us included, just having to be, either quick or honest about when something doesn't fall into a category or a stage that's right for them. But I think you can always expect that things will be reviewed and looked at. And I think, if that is the best way to get in touch with a fund, or if you don't have a contact or sort of a tangential relationship with someone, then definitely just reaching out that way. Otherwise, if you do know a company in the portfolio, or if you know someone who's worked there in the past, obviously getting sort of an insider intro can be helpful as well. but I maybe would add to that, like, I wouldn't think too hard or much about the actual introduction and how your relationship starts. You know, part of a good investor's job is to be finding companies that are outside of their network and that are coming to them from any different direction. So it's not like you'll be getting any additional consideration. Like, you know, if a company is within an investment fund's strategy, they should be looking closely at you however they hear about you.
The next question that we have is, given that situations vary and you seem to target early stage brands, what is the relative importance to you of Amazon versus conventional retail sales in the composition of brand sales to date?
Yeah, I think so. Like e-commerce overall, which for us, we sort of like group together as Amazon, as your own direct to consumer, as other online marketplaces like Faire, Hungry Root, things like that. We definitely see Amazon as being an attractive and interesting channel. It's not necessarily where you're gonna build your brand and tell the most interesting brand story, but in terms of supporting revenue, if you can show that you again have attractive metrics there, that you can acquire customers, that you can, you know, spend efficiently on ads and get good acquisition there, we absolutely see it as interesting and supportive. It can be a really efficient channel. Retail, you know, for us, I think there was this moment where there was this idea that brands could be like D2C only and grow that way, and I think that's sort of been pretty much debunked over the past, you know, 18 months or so. We absolutely see retail as a very important part of any food CPG strategy. Like, consumers still want to be able to shop for food at shelf. You know, maybe there are exceptions to that, but broadly, I'd say we want to see retail as being a real focus, and largely just because of the scale that it gives you. You know, thinking about how many doors there are across this country, like retail doing well across natural, conventional is really often how you get very big. But yes, Amazon absolutely as a component of that, and doing well on Amazon is great to see.
For our next question, what is the check size when investing in companies in the $1 to $2 million revenue range?
Yeah, so you know, if we're looking at a company that's in the past year or will do in the given year, yeah, anywhere from 1 to 2 or even a little bit higher, we are usually looking at checks from $500K to $1.5 million as our first checks in. And I would say New Fair typically doesn't lead rounds. We're usually co-investing. So we're coming in with a fund that's writing a larger like anchor check, and we're co-investing with checks of around that size. And even I'd say looking at our portfolio, just to caveat, like you will see some later stage companies in our portfolio, brands that we talked about before, like Vista Hermosa and Tacombi, Foxtrot later on, and then some of those earlier ones.
Well, we have just a few more minutes. Does anybody have any other questions for Hallie before we let her go? She's probably exhausted.
I love it.
Okay, Lex, go ahead.
Follow-up questions earlier. So if we do seek debt financing to get us to that million annual recurring, could that be seen as a negative when it comes time to invest? If like how quickly you can pay off that debt?
Yeah, I don't think it would be seen as a negative depending on the terms that you get. So if you can get attractive, favorable terms for debt or like a line of credit, I think that's great. That often is always, or that is usually based on, you know, your inventory position, also on how much revenue you've done. All those factors will be how your kind of debt opportunities are underwritten. But if you can get an attractive source of capital, that is not seen as a negative.
Awesome. Thank you.
Awesome. Thank you so much, everyone, for joining us today. It's been an incredible discussion. Hallie, you're amazing. And thank you so much to you and Ellie and New Fair for being a part of our community. Hope to see everybody at the holiday event next week. Please RSVP. We have limited space. And following this meeting, you will receive some communication from us with the recording, the slides, some contact information, and additional details. So we will be in touch, and we look forward to seeing you at the next one.
Thank you all so much. And thank you, Adrian, for having me. It's been so great.
My pleasure.